Hello, in this video, we'll be going over special issues in revenue recognition, specifically the time and value of money component. Companies recognize revenue when goods or services are transferred to customers for the amount the company expects to receive in exchange for those goods and services. I like to repeat the definition of a revenue on every single one of these videos because it's so important. And the 5 steps used to apply that principle is identify the contract, identify the performance obligation or obligations, determine the transaction price and then allocate it, and when do we recognize the revenue. Now, there are special issues regarding the determination of a transaction price. And if I go into Starbucks and buy a cup of coffee for $5, the transaction price is easily determined. It's $5. However, there are other scenarios where there is a lapse in time between money is received and a product is delivered, or a product is delivered and then money is received later. So it's common for contracts to specify that the payment might occur before or after the delivery. So if the payment occurs after the delivery, right? So we deliver the product and then later on we get the money. When we deliver the product, we book a receivable, whether it's an accounts receivable or a notes receivable. And in that case, the seller can be viewed as making a loan to the customer between the delivery time and the time that they receive the money. Alternatively, or on the flip side, a seller can recognize a deferred liability if the payment occurs before delivery. So the seller receives the money first, and then in the future, they deliver the product to their customer, right? In that case, you can say that the customer can be viewed as making a loan to the seller because they're giving them money in advance of when they're receiving their product. There's an interest charge or time value of money that is implicit in these kind of arrangements where the timing between the cash and getting or sending the product is significant. So if time value of money is a significant part of the contract, then the seller should view the transaction price as consisting of 2 components. The first one is the delivery component, which is equal to the cash price of the good or service. And the second part is actually a financing component, which is interest that is considered either paid to the customer in the case of a prepayment or paid to the seller in the case of a receivable. And we're going to go through 2 different types. We're going to go through an example that visits both types, the prepayment and paid in advance. Now, a seller can assume that the financing component of a transaction is not significant if the period between the delivery and the payment is less than a year. So even though in our examples, it's going to be the delivery and payment will be January 1 and December 31, we're going to assume that they're significant, okay? So here, let's take a prepayment where we collect money before, the seller collects the money before they deliver the product. On January 1, 2027, TruTech enters into a contract with GameStop stores to deliver 4 $240 TriBox modules that have a combined fair value of $960. Okay, this is going to be your sales price. The fair value of the product is your sales price. The modules will be delivered on December 31 of that year, and TruTech views the financing component to be significant and the applicable interest rate is 10%. What this problem doesn't tell you, and it should, is that the payment that GameStop paid TruTech on 1/1/27, but we are not told how much. Okay, we're just told that the fair value of the product is $960. So we have to find the present value of $960, and we use the present value of a dollar table, right? n equals 1 because it's just for 1 year, and the interest rate we're told is 10%. And if you're not familiar with present value tables, please go see other recordings about present value of a dollar table and how to calculate that. But so GameStop, so the present value of $960 is $873. So on 1/1/27, what is this? TrueTech is going to receive $873, and on 12/31/27, they're going to deliver the product to GameStop, deliver product, right? So they've received the money in advance. So it's like GameStop is making a loan to TrueTech. So the entry that we're going to record on January 1 when they receive, TrueTech is going to record on January 1 when they receive the cash, is they're going to debit cash, $873, and they're going to credit deferred revenue for that amount. And that's going to be a liability, right? Because TrueTech is receiving this cash in advance and they have not yet satisfied their performance obligation by delivering that product. Now let's look as to what happens on December 31st when the product is actually delivered. Okay, we have a balance sheet account for deferred revenue for $873, a credit that we booked on January 1. We're going to debit that deferred revenue because we're going to actually deliver the product. So now we have satisfied our performance obligation, okay? And we can recognize the sale because we've satisfied that performance obligation. So we're going to credit sales revenue for the fair value of those 4 TriBox modules. And then their debit is going to be to interest expense for $87 to make this entry balance, which is also just the carrying value of that liability times 10%. So this is correct because there should be an interest component because TrueTech has truly borrowed money essentially from GameStop, right? Because they got the money in advance of when they had to actually deliver the modules. So there's an interest component that TrueTech has paid for this, and they will debit interest expense for $87. Now let's look at the flip side of when the TrueTech will get the money after they deliver the product. On January 1, 2027, TrueTech enters into a contract with GameStop stores to deliver 4 $240 TriBox modules that have a combined value of $960. This will be our sales revenue. Okay, it's just a matter of when will we recognize that sales revenue. TrueTech delivers the module on 1/1/27, and GameStop agrees to pay TrueTech on December 31. So on 1/1/27, TrueTech delivers the product, right? And on 12/31, they'll get their actual money. So now in this situation, it's like TrueTech has loaned money to GameStop because they've delivered these products but agreed to get paid later, basically a year later. And again, the finance interest component is significant and is 10%. So the question is, how much money will GameStop have to give to TrueTech on 12/31? They're going to receive the products on January 1, but how much money will they need to give to GameStop on 12/31? And the answer is $1,056. We have the fair value of the products, which is $960, and this time, right, we're going to divide it by the present value of a dollar factor, which is 0.90909, to get $1,056. So on 12/31, this is how much money TrueTech will receive from GameStop. But on 1/1, they've given them products worth $960. So that makes sense that they will receive more than the products since they're delivering the products on 1/1. They'll receive more on cash on 12/31 because essentially they're loaning them money. TrueTech is loaning GameStop money. So let's see what gets recorded on 1/1. Well, on 1/1, TrueTech actually delivered those products to GameStop, and so they have satisfied their performance obligation and should rightfully recognize the revenue on that sale. So the sales revenue is for the fair value of those modules, which is $960. So they are going to credit sales revenue for $960. They should be receiving cash for $1,056 at the end of the year. So they're going to debit notes receivable for $1,056. And we're going to, in order to make this account, this journal entry balance, there's that contra receivable account, a discount on notes receivable. We're going to credit that for the difference of $96. And that is essentially going to be the interest revenue component of this transaction. So at the end of the year, right, when GameStop actually pays TrueTech, TrueTech is going to record cash for the $1,056. So they're going to debit cash. They're going to take off that notes receivable for $1,056 that they booked on January 1st, right? They have to remove that off their books, so they're going to credit notes receivable. They're also going to remove the discount on notes receivable that they booked for $96 on 1/1. So they're going to debit that discount notes receivable for that full amount, that full $96, because none of that discount has actually been amortized, because this is just a 1-year lag between the payment and between the delivery and the payment. And then TrueTech will actually recognize interest revenue equal to the carrying value of that note, which was the total note less the discount, which is $960, times 10%. So they're going to recognize interest revenue for $96. And that's because essentially the difference between the value of the modules of $960 and the $1,056 that they receive is interest revenue, because they've essentially loaned GameStop $960, and then they're going to get $1,056 back. So that difference is interest revenue.